SAP, Europe's leading software company, is navigating a storm of global trade uncertainty, slowing customer decisions and raising investor concerns. In this video, we explore how SAP's U.S. operations are being affected by tariff tensions, the recent U.S.-Japan trade deal, and the company's long-term strategy in cloud and AI. Discover what this means for tech investors, business leaders, and the future of enterprise software in a volatile global economy. Hey everyone, welcome back to Wealthy Business, your go-to source for finance, business news, and personal growth. Today, we're diving into a topic that might seem highly technical on the surface, but has massive implications for global markets, tech investors, and multinational corporations. We're talking about SAP, the German software titan, and how it's being affected by rising trade tensions between the US and the rest of the world, especially under the renewed Trump administration. Let's start with some background. SAP isn't just any company. It recently became Europe's largest publicly listed company, overtaking luxury giant LVMH and pharmaceutical heavyweight Novo Nordisk. How? By successfully pivoting from traditional software to cloud computing and now into artificial intelligence. This transformation has turned SAP into a major player not just in Europe but globally, especially in the United States, which is one of its core markets. But there's a new challenge on the horizon, and it's not technical, it's political. In a recent interview with CNBC, SAP's Chief Financial Officer Dominic Assam revealed that tariff uncertainty in the US is delaying major business deals, and we're not talking about a few small contracts. These are large transactions in critical sectors like public infrastructure and heavy industry, industries that rely on complex global supply chains and are directly impacted by trade policy. So what's going on here? Assam explained that customers in sectors like U.S. public services and large industrial manufacturers are becoming hesitant. Deals aren't being canceled, but they're being pushed up the executive chain for more approvals. It's a classic sign of risk aversion caused by political uncertainty. Nobody wants to lock in a massive tech contract if tariffs could suddenly inflate the cost of doing business across borders. Now, while this is happening, there's a glimmer of hope on the horizon. The United States just announced a new trade agreement with Japan, setting tariffs on Japanese exports to the U.S. at 15%. According to SAP's CFO, this kind of agreement could help ease some of the tension and restore confidence, but it's too early to celebrate. The big question is, will similar progress be made with the European Union? Let's break down the numbers. SAP reported a 9% increase in revenue in the second quarter, reaching 9.03 billion euros, about $10. 6 billion, just a hair below analyst expectations. But operating profit actually beat the forecast, coming in at 2.57 billion euros. The company is sticking to its full year 2025 outlook, but they also noted that the dynamic environment creates reduced visibility. Translation? Even SAP isn't sure how the year will end if trade uncertainty continues. Another key figure to watch, SAP's cloud backlog. It's up 28%, and that's huge. This is a forward-looking metric that shows how much revenue is already booked for future cloud services. Deutsche Bank praised this number, calling it strong, especially in a tough macroeconomic environment. And there's more good news. SAP has been winning new high-profile clients, including none other than Alibaba. That's a major vote of confidence in SAP's cloud and AI capabilities. But not everyone is impressed. Analysts from firms like TD Cowen and Piper Sandler have cut their price targets for SAP, citing concerns over currency fluctuations, particularly the weakening US dollar, which drags down cloud revenue growth when converted into euros. Let's take a step back. What does all this mean for investors, business leaders, and everyday professionals? First, for investors, SAP is a bellwether. It gives us a pulse on how global enterprise spending is evolving. If companies are delaying software upgrades and cloud transitions because of trade policy, that tells you a lot about where the business world thinks things are heading. Second, for entrepreneurs and tech companies, SAP's experience is a cautionary tale. No matter how innovative your product is, geopolitical forces can still derail your growth. That's why companies need not just a great product, but also a resilient strategy that can weather trade wars, political transitions, and currency shifts. And third, for anyone in business, this is a masterclass in managing uncertainty. SAP's leadership isn't panicking, they're adjusting, communicating clearly with stakeholders, and focusing on long-term growth through AI, cloud, and enterprise efficiency. That's something we can all learn from. So, what's next? The European markets were slightly shaken by SAP's announcement, with its stock falling around 3.5% in early Wednesday trading. But long-term, if the US-Japan deal is any indication, there's potential for trade relations to stabilize, and that could reignite deal-making. In the meantime, keep your eyes on the big picture. AI, cloud computing, and digital transformation aren't going away. They're just moving at the speed of geopolitics right now. Thanks for tuning in to Wealthy Business. If you found this breakdown useful, don't forget to like, subscribe, and hit the bell for updates. We'll keep bringing you deep dives into the world of business, finance, and growth. Stay sharp, stay informed, and stay wealthy.